What's up everyone, it's Scotty with MoneyVest. So in this video, wanted to talk a little bit about the bond market, of course. And just when you thought that things could get any worse, we just learned that in August, China sold over $21 billion worth of bonds and basically selling most US securities in over 4 years. And there are more important charts that I wanted to go over in this video because, again, we're seeing indicators in the market and the economy that we haven't seen in over decades. I mean, off the top of my head, of course, the yields are hitting its highest levels in over 16 years. The price to income ratio in the housing market we haven't seen in over 68 years. We're seeing, yield curve uninversion that we haven't seen in over like 3 to 4 years, and not to mention the equity risk premiums that we haven't seen in over 20 years. I mean, there's a lot of indicators just like those and of course, when we talk about the debt levels and the deficits, we haven't seen ever in the history. And the bond market, not to mention, has not sold off this aggressively ever either, right? It's just been the most brutal bond market since 1800s in over 250 years, not to mention the second longest bear market that we are seeing right now. So hope you guys enjoy this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. The link to our Discord and Patreon is going to be down below if you're interested in joining, and of course getting access to everything. So all the members only private videos, trading view charts, Excel spreadsheets, our stock reports, everything is going to be included with a link down below. And again, we'd love to have you on board. There's a 16% annual discount that's also available at the moment. So this right here is the actual chart, which basically mentioned, China sells most US securities in 4 years, and China is the second largest foreign owner of US debt. The first is Japan. They own, I think, a little bit over $1 trillion, and then we've got China at over 500 or actually 850 billion dollars, and we got the UK at over 600 billion. Then we got Belgium at 331, and then we got Luxembourg at 300 billion dollars. So China definitely sits at the very, very top of foreign investors, foreign owners of US securities. And 4 years is how long it took for China to sell most of its US securities. And again, you can see the downtick over here, and this right here were the sales in August. So treasuries almost $15 billion. We got stocks at $5.1 billion, agency bonds 1.3, corporate bonds a slight increase there, and total of over $21 billion worth of sales from China with respect to the US. This right here is basically their holdings, their treasury holdings, and you can see that it has come down to $805 billion, and it was up to as much as 1.3 trillion at one point. So this is going back as far as 2011, 2012, 2013. And you can see that it's been on a consistent decline here. China's ownership of these U.S. securities has continued to come down from 1.3 trillion down to now just over $805 billion. Now that's a 50%, not a 50%, but that is this $400 billion decrease. That's, I think, over a 30% decline from 10 years ago. And look, the prices of these bonds have come down significantly, so it's possible that the notional value of these bonds is one of the reasons why the market value of their holdings is lower. So this doesn't clearly suggest that every single year China's been selling loads and loads of bonds, hundreds of billions of bonds, every single one of these years to bring their market value of their current holdings down to 800 billion. But there's also the possibility that as rates have gone higher, the prices have come down, and as a result, the notional value, the market value of these bonds is significantly lower, right? So that's something to keep in mind as well. So it doesn't give you the full picture, but the idea is that this is trending lower. I mean, since 2000s, it's been on a very nice, consistent uptrend, and then since 2013, 2014, it has been on a significant path lower. Now, this right here is the equity risk premium. Now, how is that correlated? The way it's correlated is because obviously we know, right, if there's going to be more supply in the market, as not only is the Federal Reserve, tapering off their balance sheet, they're letting go of a lot of these mortgage-backed securities, treasuries. They're not rolling them, they're not buying them right now. They're letting them roll over off of their balance sheet. That's number one. Number two, we've seen a lot of issuances from the fiscal policy side, right? There's a lot of issuance from the Treasury Department, significant amount of auctions happening and taking place almost every day. And on top of that, you've got, sellers coming in as foreign sellers like China, Japan. If they are starting to sell more and more U.S. securities and treasuries, that's increasing to the overall supply, which is ever growing. And on top of that, you've got hedge funds and a lot of institutions selling short a lot of these bonds, which is creating even more selling pressure. And the demand is not there. The demand is not existent. I mean, it's there, but it's not to a point where it's going to be holding down the treasuries. Right now, we're down a little bit over 1% pre-market for the 10-year yield, but we got up to as much as 5%. So the high for today, as of the time I'm recording this video, was a little bit over 5%. So we finally eclipsed 5% level that we haven't seen since 2007 in over 16 years. And why is that a problem? Well, it's going to push the risk curves further out, and that's exactly why we get into this conversation around equity risk premiums. And equity risk premiums are nothing but the expected rate of return from the stock market minus the yield on the treasuries, right? That's the premium that you're making, right? Because think about it, every investor wants to invest in the stock market to make more, right? If you can get 4, 5, 6% in the treasuries, right, which is pretty much risk-free, right? It's considered to be risk-free, although that can be debatable now considering what's going on with the deficits and debt. But it's considered risk-free for the very idea and the fact that it's backed by the U.S. government. So if you are able to make 5%, right, 6%, 7% on treasuries, then the premium, the risk premium needs to be significantly higher for it to be worth it investing in the stock market. But that risk premium is diminishing very, very significantly because the yield on the S&P 500, which is the earnings yield, compared to the 10-year treasury yield, is now sitting at almost zero. So there's no benefit, right? From a risk-reward standpoint, the reward benefit has completely diminished for equities with respect to yields, right? Why would an investor choose equities over yields if they can't even make more in equities, right? And you're taking on all that additional risk to make the same, right? It doesn't make any sense, and that's why it has come down to its lowest level in over 20 years. So equity risk premium has been evaporating, and the benefit of owning stocks over treasuries have faded, and we are coming down to the same level as from 20 years ago. So these are pretty concerning things because, like I said in my previous videos, the market's very much underscoring the move in treasuries, right? Treasuries can easily absorb all the demand that may come into it if there's flight to quality, if liquidity moves out of stocks over to bonds. And this right here, is the P ratio of S&P 7 versus S&P 493. So basically the 7 stocks, the Magnificent 7, right? So big tech, and their P multiples have expanded from the start of this year from 29 to 45. 45 to 47 versus all the other stocks, 493, have gone from 17 to 19. Just a crazy amount of explosion in the valuation here for big tech and for Magnificent 7. And I would say rightly so, because these are the companies that are super cash rich. These are the companies that have got lots of growth opportunities, and they've continued to perform really well in terms of revenues and earnings. But it's possible, right? And that's where the risk comes in for the market, right? Because on one hand, you've got yields that are going higher, which affect which companies. Which of these two charts is the 10-year yield going to be affecting more? Which of these two S&P indexes, S&P 7 versus S&P 493, which of these two is more sensitive to interest rate increases? It's the S&P 7, right? It's the big tech, because their present value of all future cash flows is going to be worth less as interest rates go higher, because they're all technology innovation stocks, versus the other 493 that may be industrials, financials, banking. We got energy, we've got materials, a lot of other sectors that are part of that 493 stock list. So if this P ratio starts to compress on the back of higher interest rates, and the fact that equity risk premium is not really that much anymore, money can start to kind of flow out of equities and move over to bonds, which obviously is going to benefit bonds and could reverse us from a bond rally perspective. But the bottom line is there are certain indicators, there are certain charts that are not showing any signs of slowdown when it comes to equities right now. When it comes to the bond market right now, the yields more specifically, getting up to over 5% now at the moment. So keep a close eye on this. I'm watching the volatility very closely. So VIX here right now, just a little bit over 21. I'm watching the 30 level very closely. That's something that we have talked about on our channel, in our Discord as well. So that's really what I'm paying attention to. And I'll be looking at some long trades the moment VIX gets above 30, and beyond that level, we're getting up to over 95th percentile for the volatility. So hope you guys enjoyed this video. Let me know your thoughts down in the comment section below. As always, make sure that you drop a like, subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining. And of course, that 16% annual discount is available till the end of this month. And as always, happy investing. I'll see you all in the next video.